Good morning, ladies and gentlemen, and thank you very much for joining us for this first of our quarterly webinars that will be running over the next 2 weeks. I'm David Carstens, and I'll be hosting Liang and Tian Pan from our China team out in Shanghai. I'm in our Stellenbosch office. I hope everyone is surviving the winter and this terrible load shedding we are experiencing. So please bear with us should there be any interruptions in the webinar. As with all our webinars, please feel free to ask any questions on the Q&A function on Zoom. I'll post as many of those as I can to Liang and Tian at the end of the webinar. We have applied for CPD points and we'll be sending out the certificates automatically once we receive sign-off from the FBI, but only to the attendees that's attended the full webinar, the live webinar. We can't award points for the recording. Then for today's agenda, we're going to be looking at China and Shanghai post the Omicron lockdown, where they've basically been locked down for 2 months in their houses. I think in contrast to the rest of the world, the performance in China has actually been quite good in June. So Liang and Tian can enlighten us as to why. And then we're going to find out if Liang is any good at being an EV car salesman. So we're going to try something slightly different today. And we'll finish off with Prescient's role in China post the lockdown growth cycle. And with that, I'll hand over to Tian to take us through the business update. Thanks, Tian.
Thanks very much, Davi, and good morning, everyone. Thank you for joining us in this winter morning in South Africa. And it's a very hot, sunny afternoon here in Shanghai, over 40 degrees outside our offices here. I'm going to jump straight into the presentation. Firstly, a quick update of our products, our flagship China Balance Fund. You guys are all very familiar with. We continue to rank top 3% globally across over 3 and 5 years across our Bloomberg peers, over 4,400 of them. And then our China Equity Fund, we are consistently a top quartile fund over 3 years. We've hit around 3.5 years of track record. And then just to reintroduce our China Gear Fund briefly, it is for qualifying investors only. It's our newly launched hedge fund, and it is non-Section 65 approved, just as a disclaimer, but it's a new fund that we launched in April 2022. Overall, as a business, we have around $370 million of assets under management across our China strategy. So that's just over 6 billion Rand. That's the latest update in terms of our business. I'm going to head into the Shanghai Omicron update. So the Shanghai lockdowns have been hitting headlines over the past few months. Just to give everyone a little more detail from on the ground here, officially the Shanghai lockdown began late March. The city was split into 2 sides, Puxi, the west side, and Pudong, the east side of the river, the Yangtze River that separates the city. Most of us lived in Puxi and we were locked down for 61 days in our apartments, probably around half the time within our apartments itself, and then half the time within our apartment complexes, not being able to exit. So the government really enforced a strict lockdown to try and keep COVID cases down. With that, obviously the economy struggled, but as the lockdown went on during sort of early mid-May, businesses were allowed to get back to work and the economy was allowed to sort of kick back into action because Shanghai is such a critical part of the entire Chinese economy. The lockdown officially ended on the 1st of June, and everything is pretty much business as usual now, with partial lockdowns in specific apartment blocks where they do find positive cases. So as of early July, most of us at the office can move freely around everywhere, aside from one colleague, actually Scott, stuck in his block because someone in his block was sort of tested positive. So that's how we expect the situation to be. Just to give everyone some logic behind the Omicron lockdown, I think the media headlines tend to exaggerate things, and sometimes there's this impression that the Chinese government has gone crazy. I think what we need to understand in China is that China never really had a full-scale national lockdown, even since the beginning of the COVID-19 pandemic back in early 2020. So in terms of lockdowns, China is just playing catch-up, and the Shanghai lockdown is part of that catch-up where the government politically could not say, oh, we'll just let everything go and relax COVID restrictions, because existing cumulative deaths have been so low and existing cases have been so low. A peer-reviewed article in Nature Medicine magazine, we summarize the results on the right-hand side of the slide here. It projected that without any COVID lockdown measures, there would have been around 1.6 million deaths already, and peak ICU demand of 1 million people from COVID alone. Seeing that the entire country only has 64,000 ICU beds, that would have been chaotic to say the least. So with these stats in mind, the government, we feel politically and practically, at least has to try a lockdown. They have been successful in containing a COVID outbreak here in Shanghai, which then obviously affects the rest of the population nationally, because Shanghai is the biggest port in the world, kind of a connection for China to the rest of the world. So overall, we feel sort of pandemic-wise, the government has been very successful with the lockdown, obviously not without its economic costs. If we look at China's COVID policy going forward, I think it is very clear the government's communicated that they will continue with the dynamic zero COVID approach. What we are seeing is that there have been certain relaxations of policy. So, for example, an increase in number of international flights from certain countries, reducing inbound passenger quarantine times from 21 days to 10 days, and then easing of visa requirement for foreigners. All of these that we feel are very positive for sort of international relations and building future economic growth and economic exchanges globally. But even having seen that, I think we should not just assume that China will completely relax its COVID-19 policy. The government has communicated time and time again that they will focus on COVID zero. But we do feel that with all the experiences of the lockdowns, that any lockdowns should also have a focus on trying to maintain as much economic activity as possible, while also trying to sort of aim for the dynamic zero COVID approach. So that's where we stand in terms of China's COVID policy. Moving on to sort of the economic side of things, obviously some results from the lockdown and also the related stimulus policies that have been released. Firstly, just a look at China's unemployment numbers, not helped by the lockdowns. Overall, total unemployment has improved by the end of June compared to end of May. It was 6.1% as at the end of May. End of June was 5.9%. So that's an improvement, although youth unemployment for 16 to 24 years is at multi-year highs at 18.4%. So with a lot of graduates coming into the market, we expect the government to really focus on stabilizing the physical economy and the part of the economy that actually sort of creates and sustains employment. Looking at PMI figures, I think these figures Liang will go into slightly more detail a little later as well. We saw originally in 2020 the sharp drop when COVID was first discovered before everything recovered. During the recent Shanghai lockdown, we again saw very sharp downturn in the PMI figures before recovering back to pre-lockdown levels. So overall, the economy is getting back to its pre-lockdown levels, and we have seen that in also the market rebound in June. Moving on to stimulus, there have been a lot of stimulus policies or fiscal support, almost $70 billion in terms of tax refunds and deferred social security payments, monetary support in terms of deferred loan payments back to the state-owned enterprises, quite a lot of investment support, the largest, a $45 billion sort of infrastructure project, mostly focused on railway construction bonds. And then also in terms of supply chain, China continued to support the airline industry, and then a very firm pledge to say that the government will focus to allow freight to move freely, which is really the bloodline of a lot of the coastal provinces and coastal regions, including areas like Shanghai, where freight was actually affected during the previous lockdown. So from experience, we expect freight to be a big focus, especially given the government's official focus. After the economic update, I think I wanted to do a quick recap on sort of the China A-share market versus the China offshore market in terms of MSCI China. I think we've done a couple of these over the past couple of years, showing the updated table. Again, we're seeing MSCI China very tech heavy and concentrated in the top 10, whereas our CSI 300 benchmark covering a much wider range of companies and industries. So obviously our benchmark is the CSI 300, and most of our exposure reside in the CSI 300, which is a China domestic Asia market. But Liang will go through a little bit later how we have started picking up some China offshore exposure via a different index. But overall, still, our focus is still on the more diversified CSI 300 index. Looking at sort of the divergence of the indices since about 2020, 2021, we've really started to see the divergence in performance of the MSCI China and CSI 300 indices. We expect that divergence to continue going forward, given the very different makeups of the underlying indices. Looking at updated long-term correlations. So these long-term correlations don't move too much, but again, with updated figures, we can continue to see that if we look at the bar chart on the right-hand side, for South African-based investors, we often look at global allocations as an allocation to DM, developed markets, and an allocation to emerging markets. But if we allocate purely just to sort of blindly allocate to purely emerging market allocation, you can see that South Africa, being an emerging market, actually carries a very, very high correlation to the MSCI Emerging Markets Index, whereas the Chinese CSI 300 carries only around over 20%, a little bit over 20% correlation to the JSE in the indices, looking at long-term correlations. If we look at numbers a bit more recent, the correlations are even higher. So the line chart on the left is trying to illustrate sort of different movement profiles of both the CSI 300, MSCI EM, and the JSE All Share Index. The bar chart on the right-hand side shows the difference in correlation for the MSCI Emerging Market relative to CSI 300 when they compare to the JSE All Share. So we can see that both these have higher correlation in recent years, but if we compare the two, the CSI 300, again, a much, much better diversifier for the South African-based investor. So with that, I think I'm going to end my section. This quarter, Liang and I thought we'd do something a little bit different for the webinar, and we made a vlog-style update, a little bit of the unique car industry in China, new energy vehicle sector, something that we hope you guys will find enjoyable and interesting. And Liang will take over from me after the video. So I'm share the video now. Darby, please let us know if there's any technical issues with the video.
Good morning, everyone. We are late June here in Shanghai, very warm. We're sitting in Prescient Shanghai offices back in our boardroom after the Shanghai lockdown. We thought for this quarter we'd bring you guys something a little bit different in terms of a quarterly update, something a little bit more exciting, and something that's very different format-wise. I mean, there's been a lot of news on COVID lockdowns, on the China-US tech war, China-US trade war, and obviously the Russia-Ukraine war. So many wars and a lot of stressful topics. We thought we'd focus on something a little bit more exciting post the COVID lockdown in Shanghai. One of the ways that the Chinese government is using policy to try and revive economic growth is through a very new exciting sector, the new energy vehicle sector. And today we want to cover that sector a little bit, look through a specific example of one of the unique companies in the sector. And with that, I think I'll pass over to Liang, and he'll take us through a lot more detail on both the sector and the company we're going to visit a little bit later in the video.
Thank you very much, Tian. I think one of the key questions a lot of people ask us is, in the future of China, where does growth come from? And one of the things China have is these multiple research plans and long-term developmental plans. One of the key things they identified in all countries that get out of the middle income trap, for example, is to be able to move up the value chain. And one of the key areas that they want to focus on is, of course, advanced manufacturing. And new energy vehicles are exactly that. In China in 2021, over 3.5 million new energy vehicles were sold in China. In South Africa, that number is only 800 or so cars. If you look at 5 years ago, the new energy vehicle sector is very, very small in China. Today, when you sum up the market cap of the major leaders, it's over $300 billion, the entire GDP of South Africa. So let's first take a look at what new energy vehicles look like, what this company looks like, and later on toward the end, I'll wrap it all together for you guys. Yeah, well, everyone, welcome to NIO. NIO is an $80 billion company at its peak in 2021, overtaking traditional car makers such as BMW. And even today, after the correction of 2021, NIO's market cap is almost $40 billion, matching the likes of Kia, Sanyon, and I'm willing to bet most of you has never heard of it. Taking a look at NIO's product range, as you can see, they started with their SUVs, and the modern Chinese cars today are completely different to what you may imagine. Soviet era kind of styling, borrowed parts from everyone. The modern cars today of NIO and multiple other Chinese manufacturers we think are really, really innovative and brand new. This is the ET7. And what I think is really, really impressive about the ET7 is, as you can see, it's almost as if it's Chinese car makers growing up. They take elements of their styling, the split lights, and building a beautiful, beautiful silhouette over the cars. This car is targeted towards luxury buyers, the BMW 5 Series and your Mercedes E-Class. And as you can see, I really enjoy the modern look. The silhouette of the car is very, very low, gives it a really sporty, sleek stance as you sit around. The car itself is over 5 meters long, and what I also really like is attention to detail. The theme of the exterior is the same as the theme of the interior. What we can see that it's really, really, really modern. I think you no longer see any parts from any other automaker. Everything is almost custom designed and custom made. You have the simplicity where it makes you feel really comfortable, as if you're sitting in a lounge. And the specs of this car is absolutely insane. All the car seats come with massage functions as well as heating and cooling. There's AI Normie, which takes all your voice commands, and everything just feels extremely premium and simple at the same time. Sitting in the back seat also shows how a new electronic vehicle, because of not having a transmission tunnel, it gives you so much more space in the back seat. I'm about 1.80 meters tall, and even in the sedan, as you can see, there's almost 3/4 of space with the driver's seat where I would be driving. So the space in this car is absolutely amazing, with a completely flat floor, allowing for really easy access and very practical usage.
Okay guys, we're back from the test drive. I hope you guys enjoyed the video. We're in a different area of our office now with our coffee machine at the back. I'll do the sort of emceeing for this part of the video. And first question, I guess, for you, Liang, is you were the driver. What did you think? What did you think about the car in general?
I think it's a very interesting one. I think a couple of years ago, or even a decade ago, when you think about Chinese cars, what you think about is kind of copycats, which kind of like second tier, a mesh of different parts from different auto manufacturers, a lot of copying, and nothing that innovative. And I think what's really nice about the NIO, when you look at it, is the design is great. The interior is great, everything's unique, everything's custom built, and everything's at a high quality enough that at least, although not dominating perhaps the traditional car makers, is certainly extremely competitive as an entire package. And I think historically, if you look at traditional car manufacturing, there's hundreds of years of history of engines and transmission and all of that, where China could never catch up. Whereas by leapfrogging traditional cars and going into new energy vehicles, while China has the most battery capacity in the world, has some of the best electric motors in the world, and that allows you to deliver very competitive products, and get right to the forefront. So if you look at the entire sector, if you look around the world, there's been no new car companies. All the car companies have come from America, and the America and Japan dominate the entire car manufacturing landscape. And the Koreans came back and came in the 1990s, 2000s. And the only new electric car makers in the world, or the only new car makers in the world that's rising up in market cap, rising up in capacity, are the Chinese car manufacturers. New energy vehicles are growing at 100% a year in China. So it was 3.5 million last year. It's going to be 7 million or 7 million the next couple of years. It's 16 million cars in China alone, and globally as everyone transition, with the exception of Tesla, the Chinese car makers are probably right at the forefront of being competitive.
Yeah, definitely. I mean, from my side, I think if one thing that got me was definitely the looks and just the overall look and feel for the car. So that center console with almost 0 buttons, everything touchscreen, I think that really looked really cool. And I think one thing we didn't mention is the price of the car. I think it works out to something like 1.3 million rand. So that definitely sounds pricey in rand terms, but I think if you consider a competing electric car from Volvo, I think the XC40, a tiny SUV, I think it sells for 1.2 million rand. So the pricing is definitely on a relative basis very, very competitive. But I think Liang, in addition to the car, we've obviously spoken quite a bit about the car itself and obviously car industries. Can you give us a little bit more background on NIO specifically, and how NIO is helping the Chinese NEV and then in turn the economy to try and be revived and grow?
Of course, Tian. I think NIO is just one example of the sector, and I think the really interesting thing to me in the sector is that none of these guys would have survived if there wasn't a long-term direction from the Chinese government about developing the sector. So just to give you guys a little bit of background, NIO came, everyone's very excited with their first product, their SUV, they had cool stuff, and it started making the first SUV. So it IPO'd in the US, started very well, IPO'd at $10, but within 2 years, it ran out of money. It burned through $5 billion faster than Tesla. It created all these beautiful marketing areas in China, everywhere to build up the brand, but it wasn't mass producing cars. It didn't get the core right. So its share price dropped 85% from $10 down to $1.50. It was months away from going bankrupt. And as that happened at the same time, where they were manufacturing cars, Anhui province used to manufacture traditional cars for Ford and Chrysler. And Ford and Chrysler were also making poor cars in China. They were just not competitive. So they had a lot of excess capacity. So combined, the local government of Anhui and NIO got together in a deal and essentially bailed out NIO. The local government in the province provided all the manufacturing capacity, the factory, to really get their first car out on the road. And that injection was worth almost $1.4 billion of assets. And then the rest is history. So that allowed them to mass produce cars. They got 3 model out. They started making 90,000 cars a year, billion in revenue. They're still far from profitability, but at least they're making very competitive products. Unlikely that they'll go away or go bankrupt. That survived and creates a ton of revenue, a ton of innovation, and at the same time creates a lot of employment. So I think for us, it's really interesting how that story merges. Whereas we all think entrepreneurship as if you're by yourself, all of that, and even Tesla got new energy loans from the US, and I think that's what we see in bigger countries where the government do play a relatively active role, but it also takes a lot of private capital, a lot of entrepreneurship from the CEO, a lot of bravery to put the two together and make it a success. And I think the end result is that you have this massive sector. As I mentioned, China's dominating the battery capacity. You've got NIO, you've got BYD, you've got XPeng, you've got all the software. Tian was mentioning about driving software, and I think one of the things people don't realize is when you drive one of these new vehicles, it's almost like moving from an analog phone to a smartphone. You know, they're all connected to the internet. You know, everything's connected, the whole software, the auto drive, the AI, the sensor technology, the LiDAR technology. So that entire value chain now exists in China, and it'll be a source of long-term growth. So, I mean, would I buy NIO? I think probably not, simply because, you know, we're quant managers, we're more rational people. You know, it's priced at half of BMW, but sells, you know, 1/10 of the amount of cars. You know, so whereas, you know, if you want to buy, you can just buy BMW. But I'm much closer to buying the car than the actual share, and that in itself says a lot, right? That in itself says a lot, that it's transitioning. You know, China's manufacturing is transitioning from cheap, low-quality products to a far more competitive and far more value-added products that we're starting to see.
Yeah, man, definitely. I think, like you say, it's almost, definitely moving from analog to digital. Kind of, the feel of the car was definitely good. The showroom was good. I mean, you guys would have seen on the video. I think, for South Africa, we may even get the help of these guys to try and give us some electricity capacity to help solve our ESCOM problems. One day, maybe, if ESCOM cannot solve its own problems. But I guess, overall, in terms of the outlook for the Chinese economy post-COVID, I guess a thumbs up question, do you think we're still going to hit 5.5% GDP growth this year in China?
I think it looks unlikely. I think it looks absolutely unlikely. I think if you look at government policy making, certainly, there's a lot of support for infrastructure build, but there's no support for creating excess debt in the housing market, which is a traditional way of getting a lot of growth out of China. And I think that's a bad sector to boost up. Housing is very expensive. We don't want to blow up a bigger bubble to try and bail China out. But having said that, governments are continuously studying many, many different policies, and NEVs are just one of them. They're about to build the world's largest, essentially largest natural battery. They're going to build the gigantic dam and use hydroelectricity storage to power the rest of China. That plan was supposed to be only built in 2035, building a little bit every single year, and they're going to push that forward by probably a decade and really spend to get that project up and running. I think so. That's the kind of stimulus we're probably likely to see. But the result of that is that growth is likely going to be a bit slower. I think COVID hit China pretty hard this year. But I think we're reasonably confident that overall policy making is supportive of a long-term sustainable growth, which we believe is the most important thing for China.
Okay, cool. I think that's it from us in terms of the video. Hope you guys enjoyed this slightly different video or sort of chit-chat update, and we hope to give you guys more sort of unique and relevant content in future.
Okay, thanks for sticking through with us. We've had a little bit of technical issues. As always, when we're trying to do these type of things, the computer keeps surprising us on what it does every single time, but hopefully most of the video played okay. And if not, it will be available for download on the Prescient YouTube channel. Right, so I'm going to take over from Tian and give you guys a quick look at what's happening in the markets and how we position as a fund. So kicking off, I think there's a very clear sign that the US and China are in a divergent position economically. So we have US CPI hitting at about 8.6%, persistently high. The transitory inflation did not turn out to be very, very transitory. And when you compare to Chinese inflation, though, although rising, it's still at a very, very low level. So we're looking at anywhere between 0 to 2%, and currently seeing about 2.1%. And having a COVID once again affect inflation, demand in China. So inflation in China is not a problem. And that's very good for us, because when you want to do a stimulus, it's crucially important that there's room to do a stimulus. And we're happy to say that on the inflationary picture, that's very, very good. On the interest rate side, you're seeing the exact same thing. So what you're seeing on the red line there is the US 2-year interest rates. And you can see that ever since COVID occurred in 2020, the US essentially had 2-year rates at 0%. And over the last year or so, that 2-year rate has gone from 0 all the way to over 3%. And that's quite a big adjustment for the economy. It's something that the economy has to get into. That combined at the same time as a lot of the stimulus running out, combined with high inflation, puts them in a really tricky spot. Vice versa, you've seen that with the recent lockdowns in China, as well as constrained inflation, what you've seen that Chinese two-year rates are actually quite low. And we've had very stable interest rates. So we never had the 0% interest rate that creates bubbles within the Chinese market itself. It's why the Chinese equity market has been reasonably valued and why the Chinese property market has not, in the last couple of years, so earlier on in the decade, has gone absolutely mad, but at least in the last few years have been reasonably constrained. And that remains to be the case. Right, taking into our top economic factors in our economic model, and what we're seeing on a high frequency basis is that although looking backwards, the economy is extremely weak, the economy is recovering. So everything from PMIs to electricity to crude steel to freight traffic to passenger car sales to commercial car sales, almost everything is recovering. So far so good. And the risk, of course, is that if we have another big COVID lockdown, that will be very, very painful to the economy. But so far, there's some risk, but certainly not the base case. Right, so to remind everyone, whenever we do asset allocation, there are three things that we would like to see. So number one, we'd like to see that valuation has to be cheap. Number two, what we'd like to see is policy. Policy has to be supportive. And number three, what we really also drives our final allocation is sentiment. So sitting right now in June, what we can say is certainly valuation is extremely cheap. Policy is supportive. We know stimulus is coming. We know government want to do it. They have the capability of doing it, and it's all likelihood going to come through. And finally, in June at least, sentiment was very, very good. Although in the last couple of days, there's a little bit of a COVID scare. We'll continue to monitor very, very carefully. So if you look at our asset allocation, we spent most of 2021 at some of our lowest equity allocation, around 50% for a very, very long time. And we started picking up equities actually towards the end of March. So in the second quarter, we started to pick up equities, and our equity allocation has gone from 50% to 80% as of the end of June. And that's exactly on a combination of what we see, a recovering economy, positive policy, improving sentiment, and very, very cheap markets. Right. So as a result of our asset allocation, as you can see, markets are down almost 20%. We're down around 7.5% since the first quarter of 2021, which means that we've avoided some of the drawdowns of the cycle. And on top of that, what we're looking to do is to put more assets into risk assets, try to take advantage of the recovery if and when it starts to occur. And one of the things we've taken an allocation to, which we previously have not had, is option strategies on the HSCEI index. The HSCEI index are essentially major Chinese stocks listed in Hong Kong. And currently it's sitting at a P ratio of around 6. That is the cheapest we've ever seen since the great financial crisis back in 2008, with both the market index level as well as P ratios as low. Well, P ratios are all-time low, in fact. It's the cheapest it's ever been. With the market as low as its 2008 lows, and we think it's a really, really good opportunity. More importantly for us as well, is that index itself has almost 36% exposure to tech. So one of the big themes that came through in the last 15 months is this fear around the biggest tech company in China. These companies remain some of the biggest companies in the world, remain some of the biggest service providers in China, some of the big employers within China. They have really innovative products, really, really strong ecosystems, and there's some regulatory worries surrounding them. But having said that, what we can see sitting here definitely is that they're fantastic companies trading at literally decade-low valuations. So it's probably one of the best opportunities to own these type of companies. Having said that, one of the crucial things for us as Prescient is always we look at the risk-return payoff, right? So it's not just, it's a great opportunity, but you don't want to bet the farm. You don't want to get exposure to this only to have something, a black swan occur and really wipe you out. So on this index, what we've done is we've taken exposure via derivatives. And what it actually means, and this one I'm showing here is a payoff profile, is that when the market goes up, we have a lot of the upside, but at least we're protected for around the first 20% of the downside, where we would only lose around 2% of our fund value. And by doing structures like this is what allowed us to deliver higher or better risk-adjusted return. As we mentioned, one of the key things that we tried to do to differentiate our product from the rest of the world is if you start with a typical efficient frontier and a typical balanced fund where you have some risk and some real return. What we want to add for our clients is, number one, we get security selections alpha. So we pick stocks and pick bonds to get you some alpha. Number two, we do active asset allocation, right, to give you a dynamic allocation so that you get more exposure to equities more towards the bottom of the market and less exposure to equities towards the top of the market. And finally, we do a lot of risk controls, whether it's by our risk model or whether it's by derivatives. It's what will enhance the risk return payoff for our clients over the long term. And when you look at that, that's exactly what we've delivered over the long term. The 10 years that we've been running this fund, the fund total return has almost doubled. A typical 65-35 balance fund, and of course also delivering close to inflation plus 9 over a 9-year compounded period, especially with a recent correction in the market and the cheap valuations. From this point going forward, we still think can deliver very high real returns because the market is more more cheaply priced, although there are always risks in the market. When you look at it over the cycle, over a longer period, so 3 years and 5 years, we're in the top 3 to 4 percentile. We're just about to get our 10-year number in October this year. Oh wait, October next year. We're on our 9th year this year. And we suspect that our approach over the long term, by delivering better risk-adjusted return, will get us towards the top 5 percentile of all asset allocation funds over the time frame. So to summarize, before I open up to questions, the lockdowns hurt China significantly on an economic basis. It's what we've seen, a correction in the equity market, very significant one, but we are coming out of the lockdowns. China has plenty of room for some more stimulus. We're not dealing with an issue where inflation is out of control. We're not dealing with inflation where we're coming from a very low zero interest rate, none of those things. So China was quite prudent throughout the entire COVID situation, and as such, there has a lot of policy room to create more stimulus. The post-lockdown rally has been strong, but market fundamentals are strong. One of the things we do worry about is the global environment, whether the US is going to a recession, whether Europe is going to a recession, and external risk with high energy prices around the world, something that we're monitoring. But one of the key things we've always said is that investing in China, what's really nice about China, and earlier Tian showed the diversification benefit, is that it's big enough to have its own economic cycle. So it's not completely tied with the US, not completely tied with Europe. Of course, a better global environment is good for everyone, but it's big enough to have its own cycle. So one of the big risks we're watching out for is, of course, repeated lockdowns. That will be very, very painful for the economy. What I can say is that Shanghai is continuously doing mass testing every 2 to 3 days, which is something we haven't been doing in the first outbreak. So during the first outbreak, there was no mass testing. At some point, hospitals started seeing more and more patients. They did a mass testing and they found, oh, we're in trouble. There's so many COVID cases. Whereas this time around, we've repeatedly done mass testing. And experiences in Guangzhou, for example, do show that that does help in terms of slowing down, or at least hopefully controlling an outbreak. It is something we will monitor for. So if something like that is to occur, of course, we will adjust positioning. But otherwise, I think we will be taking a little bit more risk than we have perhaps over the past year. And finally, we are very well positioned to capture the market and economic recovery. We have our A shares, our basic share portfolio, which we're buying more and more shares. At the same time, what's happening in, we've always been said over the last couple of years of how the tech has been so overvalued, priced in a wonderful outcome, priced in crazy growth. And you had China opening up a lot of retail investor buying it. And I think if you look at today, the opposite is true. Everyone thinks that sector is worth nothing for some strange reason, in spite of the fact that these companies have almost 1 billion customers who continue to use their product, continue to spend money on it. And if there's one thing that lockdown has showed us, we always say in the team, is how reliant we are on these platforms. Certainly that the inconvenience caused when we do not have access to them is absolutely huge. So that's where I'm going to end our presentation and open it up for questions. I think we do expect strong real returns of current valuations. Thanks, guys. I'll open it up for questions. Davi, would you like to read out some of the questions you're seeing?
Yeah, thanks a lot, Liang and Tian. Tian, we've got some comments around getting Jeremy Clarkson next time around. So you need to stick to fund management then. I think let's kick off with the sort of lockdown and COVID. Question around sort of, there's been over 3 billion doses given, so more or less 3 jabs per person. Why is there still a need for a soft hard lockdown?
Great question. I think one of the fundamental problems with vaccines is that even in China, it's voluntary. So Beijing tried to have a vaccine mandate, but it was turned down very, very quickly. So what you end up happening is the people who are most immune to it, so the young educated population and the wealthy population, we all got vaccinated, so all of us are fully boosted. And the area where the most death occurs, which is old, weak people with pre-existing conditions, they are the people that remain unvaccinated. And the problem with China is that we're such a big country, we have 1.6 billion people. So they looked at Shanghai, for example, we're 80% vaccinated as a city. But for the elderly, people above 80 years old, that number gets down to 50%. And that, I think, is an issue. Now that combined with earlier, as Tian mentioned, I think people forget China is a socialist country. We have a free public healthcare. And what happens is that the healthcare sector is typically quite busy. It is free, but it's limited. It's not as widespread as the rest of the world. And once you get out of the tier 1 and tier 2 cities, which accounts for probably around 60% of the entire China population, you have another 40% of the population where medical resources are extremely limited. You're talking basic medical resources. And I think the combination of those two things is exactly what that peer-reviewed study will show. There's 1.6 billion people, and the expected death is about 1.6 million. So it's quite, in a percentage term, it's quite small, but it is still an extremely difficult thing to accept. Is that you're making a decision of do you protect your economy or let 1.6 million people die? Now, if you think about what the United States did post 9/11, which is 3,000 people, what is the price of 1.6 million people? So they really did not have a good choice. So as a young person, as a person in finance, we of course says we want to be open, we want to be out and about, but we do understand that it is a very high price to pay should we open up immediately.
Thanks, Liang. Maybe on when you started off with unemployment, 5.9% is still a lot of people based on the number of people in China. Do you know what the non-urban unemployment numbers are?
Well, it's very, very difficult. So in China, always, because it's such a big country, it's very, very difficult to get the data. And because a lot of the nature of people moving from rural areas to get work in the urban areas, that number is even more and more difficult. But just to put into that 5.9% context, even that is probably the highest number we've ever seen in China, right? So the economy is certainly struggling. And it's on a variety of things, the disruptions of COVID, the housing market slowing down. So China has had a housing slowdown for almost 4 or 5 years, trying to get that bubble deflated over time. So there's a lot of things that's causing this higher unemployment. And that's why we're saying, the situation is ripe for some stimulus. You're not in a situation where you have full employment where stimulus is not useful. So the situation does call for some stimulus, and why we expect some stimulus to come through.
Cool. I think, there's a lot of questions coming through. We won't get through all of them, but we will reach out to you, to the ones we didn't cover. So I think we're seeing some headlines around banks starting to fail. This is, is there no intervention from the central bank? So is this something we need to be concerned about?
Oh, there's lots of intervention from central banks. So banks have been failing the last couple of years all the time. And I think the basis of it is very, very simple. There's two types of products. It's either deposits or it's wealth management products. In the case of a deposit, the central bank almost always steps in and almost all retail investors get their money back. As long as it's a deposit and up to deposit insurance, retail investors has nothing to worry about. It's mostly a restructuring process and getting the deposit back. The second part is wealth management products. Wealth management products are what happens when these banks essentially sell asset management products, but people thought they were guaranteed. They are definitely not guaranteed. They're extremely high yield. So if you're buying a wealth management product at 9%, and then the bank fails, you are not getting your money back, regardless of how much protest you would do in front of the banks. So I think in smaller rural banks, we've seen, especially with the property slowdown, we've seen that the small rural banks, which is always the riskier banks, and often private banks, so banks owned by private owners rather than government owners, typically take higher risk. They would typically loan to people that government state-owned banks are not willing to loan to. And they are the ones that get into trouble. And what you'll see is that the Chinese central government will always bail out the depositors. But if you've taken out a risky investment, You've signed, they prosecute all the people to commit the fraud, by the way. So all the people that got into the banks into trouble, if there's any fraud. So we've got to separate fraud from incompetence. Sometimes you just make bad investment decisions, and that's incompetence. But if the bankers committed fraud or mis-selling of products, they will be punished and go to jail. Vice versa, all the depositors will be bailed out by the central government. But everyone who bought wealth management products at high yield and high yield products, they are not going to get bailed out, and they will not get their money back, in spite of, as I mentioned, protests.
I think let's do two last questions. Sorry, just opening them up again. Did China apply any QE since the great financial crisis? And then a second one is sort of, should we be worried about more regulation in the tech sector in China?
Good question. So firstly, no. So China did not apply any QE since the great financial crisis, because we've all had positive interest rates. You don't need to do QE if you have positive interest rates. QE was a cure for interest rates going to 0%, and you cannot cut interest rates below 0%. So that's also part of the reason why China has a lot of room for stimulus if they choose to go that route. As we mentioned, we don't think they will take it to that extreme. The point of stimulus is not to get you a massive bull market. The point of the stimulus is to get you out of the economic slump, which is what we expect. They'll do enough to get them out of the economic slump to stabilize unemployment, but the rest of the market must solve itself. So second question on the tech sector, I think the government also kind of talked through this and been reasonably supportive in the last couple of quarters, right? So number one, there are existing rules and laws when it comes to anti-monopoly, taxation, money laundering, social security, etc., etc. These laws will be implemented. So if the companies do not behave and do not implement these laws into their business practices, they will get fined, and they're not giving up on those rules. Once the rules are out, they have to be implemented. Vice versa, the Chinese government also tried to come out and really kind of clear the market. What they tried to do better is communicate better, more consistently, and try not to surprise the market so much in terms of these regulations that will come out. I think tech platforms are going to be regulated around the world. You've seen it in Europe, where Apple is now forced to make use of universal ports, not a proprietary port for their charging. You've seen it around the world on terms of social media, fake news, all of that type of things. And that's not going to change in China either. That will continue to be there. But that does not mean, as I mentioned, that these companies are worthless, or does not mean that these companies will no longer not make a healthier profit. It just means that the kind of the wild, unsustainable growth years are past. But there's always a valuation that makes them very, very attractive. And currently, for some of them, the valuation is extremely attractive.
Thanks, Liang and Tian. I think we're going to leave it at that for now. Thank you, everyone, for joining today. The recording of the webinar will be available on our YouTube channel in the next day or two. As I said, we will be sending out the CPD certificates automatically to everyone that's attended the full webinar. We're hosting 3 more quarterly updates coming up in the next 2 weeks. Equity one is on Friday, so if you want to join that, please register. Yeah, thanks a lot, Tian and Liang, and have a great week further. Bye.
Thanks, everyone.
Thank you.
Bye-bye.